Hey, welcome back, options traders. I hope everybody had a fabulous weekend. And I wanted to touch on a topic that comes up a lot under various conditions, but it's when break-even calculations break down. And the main reason this happens is when traders use their eyes to look at a risk graph. Usually they bring it up in their broker's platform and they'll say, oh, I recognize that as a straddle or as a vertical spread, and I know how to calculate the break-even points. So they go back to their basic formula and they end up that it's just dead wrong. So how can that happen? Well, let's go have a look. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and definitely helps to promote the channel. Now I'm going to use an example that I've used in the past because it's really a good example of where these calculations can break down. But take a look at this vertical spread. And so a trader might look at this risk graph of this vertical spread and see that we have a bend right here at 100. Remember, we always get a bend at a strike. And so they'll say, well, it lines up here at -5, so I know the formula. You take the lower call strike of 100 plus the premium, we add them together, and we get 105. And therefore, this break-even must be 105. And they go on about their business, not really even checking the numbers. That can't possibly be right. Take a look at the maximum gain up here. It's also +5. And if you think the break-even's at 105, well, then how is this number 105? Something is off here. It looks like a vertical spread, and we got the bends correct. There is a 100 strike involved. We know the maximum loss is 5. How come we're not breaking even at 105? Well, once again, this is a really good example where using your eyes and your throwback formulas can really fail. In this case, what happened is somebody was trading straddles. And so let's say that they buy the 100 straddle and sell the 105 straddle. And if you do this, yes, it looks like the 100-105 vertical spread. Here's a breakdown of it. So at the 100 strike, if we buy the 100 straddle, we are long the 100 call, and we are long the 100 put. And if we sell the 105 straddle, we're short the 105 call and short the 105 put. But take a look at these vertically by calls and puts. This is a bull spread. We're long the 100-105 vertical spread, and we're short the 100-105 put spread. This is a credit spread. So we really have two vertical spreads going on here. Doesn't look like it when we just looked at that risk graph, and that's part of the point. So let's break these down separately. Here is the long 100 straddle. Here is the short 105 straddle. And if we put them together, yes, we get this in black. So we did get the strikes right. There is the 100 strike, a bend right there. There's another bend right there at 105. But that doesn't mean that you have the 100-105 vertical spread. And as I've shown before, if you look over here, there's some clues. The ranges between these two strikes, notice that we have 100 deltas here, kind of leaning off to the right. But we've got another parallel line over here. We actually have 200 deltas. And so even though we only have $5 difference between these strikes, because we have 200 deltas, we are getting to that break-even point twice as fast. And that's why it's going to behave like a 10-point spread. So if we just look at this one again, enlarge it, there's your -5, there's your +5, even though we've only got $5 worth of difference between these strikes. And again, that's because of 200 deltas. It's a very easy mistake to make, not just in this strategy, but in all kinds of strategies where you're buying and selling, legging in and legging out. So why is it in this case that we have a symmetrical, what appears to be a vertical spread? We have -5 for the maximum loss, we have +5 for the maximum gain. So it looks like a 10-point vertical spread that was purchased for $5, but it's not. So we have the right to buy at 100 with our call. We have the obligation to sell at 105 with our short call. For the puts, we have the obligation to buy at 105 and the right to sell at 100. So we have a $5 gain balanced by a $5 loss. It's only the extrinsic values that are going to shift this black line up or down. So this graph was apparently created with the stock right here at 102.50, where the extrinsic values just netted out. And so that's why we end up with a symmetrical -5 +5. But what if we had constructed this maybe when the stock was at 100? So now the 100 straddle is all extrinsic value, and the 105 straddle has 5 points of intrinsic value on the put. What would happen now? Well, if we go to a pricing model, let's put the stock at 100. The $100 call, let's say, is priced at 228, and the $100 put is priced at 228. Notice with the stock at 100, both of these are all extrinsic value. The 105 call, however, is worth only 64 cents. It's 5 points out of the money. But the 105 put is worth 564. Notice that the extrinsic values here are the same, 64 cents. The 105 put sure has an extra $5 of cash, but that's because it's $5 in the money. And as I've pointed out in many videos before, when you're looking at your strategies, the only thing that matters is the extrinsic value. So on a net basis, this $100 straddle has $4.56 of extrinsic value. That's just 228 plus 228. The 105 straddle on a net basis has $1.28 of extrinsic value. That's the 564 here, but we've got to subtract out the $5 of intrinsic value. So we really have 64 cents plus 64 cents, or $1.28. So notice that if we buy the 100 straddle, we're spending $4.56 of extrinsic value, and we're receiving $1.28 of extrinsic value. We are not receiving $6.28 of extrinsic value. That's the 564 plus 64 cents, like so many traders think. It's $1.28 of extrinsic value. So if you pay $4.56 and you receive $1.28, you would have a net debit of $3.28 to buy the 100 straddle and sell the 105 straddle. Your maximum loss would be $3.28, and now you're starting to see the picture. Yes, minus $3.28 here on the left, and the maximum gain is $6.72. Again, it's behaving like a 10-point vertical spread, even though we've only got $5 worth of difference between the strikes. But that's because we have 200 deltas in the center. So hopefully you can see how tricky that can get. So just be very careful for any of the traders out there who might be looking at a risk graph, especially if your broker's platform doesn't give you the details, and you say, oh, I can see if that's a vertical spread, and then you fall right back on your calculations and end up in a heap of trouble because you never saw the 200 deltas in the middle. And that's why it's so important to understand the mechanics, not just the definitions of your option strategies. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.